Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for the segment, we have Mark Giambrone. He's the head of U.S. equities at Barrow, Hanley Global Investors, to discuss why now is the time for value and active management and why it will continue for quite some time. Mark, it's great to have you back on Trade Talks. Welcome back.
Thanks, Jill. Thank you so much for having me.
You got it. And let's talk about that, why you think now is the time for value, certainly for active management, and why you expect it to continue at least through 2023.
Sure. Maybe I'll start with the active first. As you know, over the last decade or so, the market has been led by the very largest portions of the market. That's why we came up with this term FANGs, right? There's a reason, because some of the largest names were becoming a bigger portion of the benchmark, and they were doing better than the average stock and therefore driving the index. In the environment we're going into, in my opinion, the average stock will now be in a position to do much better than the largest stocks. And therefore active, meaning when you go in and pick individual stock names, is going to do better than just the indices, which are now dominated by just a few very large names. So it seems to me as though this is an excellent period for active. And then it will also be an excellent period for value because, again, of the environment we're in. So, low rates, low inflation, good growth tends to lead to highly valued or the most speculative portions of the markets doing the best. And that makes sense. And so over the last 12 years or so, we've seen, again, the FANGs, crypto, SPACs, you pick it, that tend to benefit from very low rates. Why? Because low rates means the future can be more valuable when you discount that back to today. And as rates rise, as we're currently seeing, and the Fed is taking away liquidity in the market, inflation is very high. That generally leads to a slowdown in the economy. You find that, value and the more cyclical names actually do better in that type of an environment. And I think that's the type of environment we're moving into. And so we feel really good about active. We feel really good about value. We are active value managers. So I guess you would expect us to feel that way. But really where we are from a valuation perspective and the environment we're currently in tells us that we're in the early innings of what will be a significant value run.
Right. Well, I mean, this certainly is the environment for you. And to your point, the Fed still has work to do because the economy is still strong. So I guess the key question is, when does the market bottom?
Sure. That's a good question. I will say that normally the market does not bottom until economic indicators have bottomed. And as you mentioned, most of the economic indicators are still very strong. The economy is still too strong from the Fed's perspective, especially in certain places like employment, et cetera, supply chain issues, demand. And so, unfortunately, there is work to be done. I don't think we're at the bottom yet. In my experience, we find a bottom when people can't stand talking about it anymore. I still turn on some of these TV shows and they talk about, are we at the bottom? What can we buy at the bottom? In my opinion, at the bottom, this is my experience, people are saying, please just get me out. There is no bottom. And I don't think we're quite there yet. So as the Fed, also rates rising and liquidity effects have a lag effect. And so normally it's a year or so. So probably about this time next year would be my guess, is we'll be bottoming. And by the way, being in a recession is not the worst thing for the market. Uncertainty is the worst thing for the market. And we have lots of uncertainty at the moment. Are we going into recession? How bad will it be? Where will the Fed stop? What's happening globally? And so because of all these things, we're in a very difficult period for the market to find footing. I don't think we'll find footing quite yet, but I do think if you fast forward into sometime next year, and even if we're in a recession, that's okay. Then the market can say, okay, here's where we are. Now we can figure out what earnings and cash flows might look like. We can think about what multiple we're at. We can think about how things improve from here, and we can get to sort of an extended up market again, which I think will be coming, but we're not there yet, unfortunately.
Right. And Mark, that's a great point that you make, that we have to remind ourselves as investors that the economy and the market are two very distinct things. And I think that really has been, to your point earlier, the past decade, 13, 14 years, let's call it, it's been so intertwined because of the flush of liquidity in the system. And I think investors have to exercise some sort of patience here, because it is going to take time for Fed policy to play out. That market of, buy the dip and expect to see asset prices go from, up and to the right. It's just a very different market environment right now.
For sure. I think that number one, the market is a discounting mechanism. So it's looking forward and should tend to be therefore ahead of what we're seeing. Economic indicators are also things in the rearview mirror for the most part, right? We get lagging data and the market's looking forward. That's one. And so also to me, the market will and should, be able to move through things once we get some certainty. That's where I feel good about that.
All right, Mark, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you, Joe.